All loans written by a private company and not insured or guaranteed by the federal government are called conventional mortgages. What this means is that if the customer defaults on the loan, the government will not subsidize the company's loss. This makes the loan more risky to the bank and thus requires more stringent criteria for acceptance. We'll get to that a bit later. For now, let's see what makes up a conventional loan. Conventional loans are usually described with a few sets of defining attributes. Conforming or non-conforming. What this means is that the loan either does or does not conform to the standards set out by government-sponsored entities Fannie Mae and Freddie Mac. Non-conforming loans cannot be bought by Fannie Mae and Freddie Mac and are considered high risk as the standards set are done for mortgage protection. Some of the standards for conforming loans include 1. No more than a 97% loan-to-value ratio. Your loan-to-value ratio is the percentage borrowed of the home's value. 97% is the upper threshold upon which a loan can still be classified as conforming, meaning that you must have at least 3% equity tied to the loan or down payment. 2. A minimum credit score of 620. Your credit score is a 3-digit number generated by a mathematical formula designed to predict risk. Financial institutions use a FICO score, and you can check your report by visiting myfico.com. 3. No Chapter 13 bankruptcy filings within the last 2 years or Chapter 7 bankruptcy within the last 4 years. In the event you've filed for bankruptcy within this time period and have applied for a conventional loan, it will be classified as non-conforming by Fannie Mae and Freddie Mac. 4. Fixed expenses and debt no more than 45% of your monthly pre-tax income. Add up all your monthly bills and debt payments. Be sure they are less than 45% of your total income before taxes are withheld. If they aren't, you may wish to pay off more of your debt before attempting this type of loan. Your DSLD loan officer will help you gather any required documentation, which is essential to qualify for a conforming loan. Once it is determined that your loan is conforming, additional details of the loan can be discussed. This includes 1. A fixed or adjustable interest rate mortgage. Adjustable rates are typically fixed for a short duration of time and then fluctuate annually. Fixed-rate mortgages are more sought after by homebuyers because they provide a consistent payment month to month for the life of the loan. 2. Mortgage insurance. Some lenders require private mortgage insurance if your loan-to-value ratio is higher than 80%. The amount of your insurance premium is dictated by your risk of default on your loan. This varies, but is typically 0.3% to 1.15% of the original loan amount per year. Drawbacks and benefits of conventional mortgages. Some drawbacks. Many private lenders require higher down payments. If not, lenders might require private mortgage insurance to mitigate their risk if your loan-to-value ratio is higher than 80%. Also, certain banks might require higher credit scores to remain risk-averse. Some benefits. Banks set many of their own underwriting guidelines and risk aversion policies because they do not have to operate under the more stringent guidelines of FHA, VA, or RD loans. For that reason, you may not be required to provide such rigid documentation. To some degree, your lender dictates the amount required. Additionally, if you meet the bank's criteria, you may have access to lower interest rates. So, if you think a conventional loan may be right for you, contact DSLD Mortgage today to get started. If not, don't worry. There's an array of other lending options available. Watch our additional videos for details on FHA, RD, and VA loans.